Wow. Okay, so D-Mart just released their financial results for the quarter and 9 months ending December 31st, 2024. And the numbers are, well, there's certainly something to unpack.
Absolutely. It looks like they've had a pretty busy few months. Let's dive right in, shall we? So, their standalone total revenue is up by a pretty solid 17.5%, reaching rupees 15,565 crore for the quarter. That's a significant jump.
Yeah, 17.5% is a nice chunk of growth. And their standalone profit after tax or PAT is up too, but at a slightly lower rate of 6.5%, coming in at rupees 785 crore. It's interesting to see the revenue growth outpace the profit growth, isn't it?
It is actually. That often suggests that while they are selling more, there might be some pressure on their profit margins. Think of it like they're selling a lot more lemonade, but it's costing them a bit more to make each glass.
Okay, that makes sense. So their EBITDA, which is earnings before interest, tax, depreciation, and amortization, also saw a 10.2% increase, landing at rupees 1,235 crore. Seems like a bit of a mixed bag of growth rates.
Exactly, you've got it. When EBITDA grows faster than profit, it often points to things like increased operating costs or potentially some fluctuations in depreciation expenses. It's like the core business is making more money, but other costs are cutting into it.
Right, gotcha. And what about their earnings per share, the EPS? I see that's also increased.
Yes, their basic EPS for the quarter is up to rupees 12.66 compared to rupees 11.32 in the same quarter last year. So that's definitely a positive sign for investors. It's like saying each slice of the profit pie is now slightly bigger, if you know what I mean.
Okay, good to know. So they also added 10 new stores in this last quarter. That's pretty significant expansion, right?
It is. It means they're not just focusing on existing locations, they're actively expanding their reach. Think of it as planting more seeds, hoping for a bigger harvest in the future.
Now, let's talk about the 9-month figures. It looks like total revenue for the 9 months ended December 31st was rupees 43,327 crore with a 16.7% year-on-year growth. That's pretty consistent.
Yes, it is. And their EBITDA for the 9 months stood at rupees 3,561 crore, showing a 12.7% growth. Again, a solid increase. It's like they've got a good engine that's chugging along nicely.
And the PAT for the 9 months?
The PAT for those 9 months is rupees 2,307 crore with a 10.4% year-on-year increase. So their profit has grown steadily over the last 3 quarters. Think of it like a steady climb up a hill.
Yeah, that's a good way to picture it. Now, it's also worth noting that their basic EPS for the 9 months is rupees 35.47, up from rupees 32.15. So that's again good news for investors.
Absolutely. It shows consistent growth in their earnings, and it's a key metric for investors to track. Think of it like a report card for their business performance over the 9 months.
So, in terms of overall financial health, it seems like they're doing well. But what about the margin pressures we discussed earlier?
Exactly. While the revenue growth is strong, the slightly lower growth in PAT and the lower margin percentage suggests that they might be facing some cost pressures. It's like they're running faster, but they're also using more energy.
That makes sense. Now, they also released consolidated results, and those numbers are a bit different.
They are. The consolidated revenue for the quarter is slightly higher at rupees 15,973 crore, which is understandable with their subsidiary businesses included.
Yeah, and what about the consolidated profit numbers?
The consolidated net profit is rupees 724 crore for the quarter, which is lower than their standalone profit, showing a margin decrease. It's like you're running multiple lemonade stands and some of them are doing better than others, if you know what I mean.
Right, okay. The consolidated EBITDA margin also took a dip, right?
It did. It's at 7.6% for the quarter compared to 8.3% last year. So that margin pressure we talked about earlier, it seems to be affecting the overall group as well.
Interesting. So, what about the 9-month consolidated results?
So their consolidated total revenue for 9 months is rupees 44,486 crore, and the net profit for the same period is rupees 2,157 crore with a PAT margin of 4.8%. So again, while the revenue is up, margins are slightly down compared to last year.
Okay, so it seems consistent across both standalone and consolidated, that revenue is up, but margins are facing some pressures.
Correct. It highlights that while DMart is growing, they are also dealing with some cost challenges. It's like they're expanding their garden, but the cost of fertilizer is also going up.
Now, the press release also includes some interesting comments from their CEO. What did they have to say?
Well, Mr. Neville Noronha mentioned they've seen increased discounting in the FMCG category, which has impacted their high turnover per square feet stores in metro areas.
Okay, that explains some of the margin pressure, right?
Exactly. Increased competition and discounting, they're basically making it harder to maintain those higher profit margins, especially in the big cities. It's like a price war in the neighborhood lemonade market.
He also mentioned that DMart Ready, their online channel, grew by 21.5% in the 9 months.
That's right. It shows that their online delivery business is growing and becoming a significant part of their overall operation. It's like they've added a mobile lemonade cart to their business.
And interestingly, they noted that home delivery demand is much higher than pickup points.
Yes, that's a key insight. They're adapting to where the customers want them, which is convenient and makes sense. They are aligning their business with the consumer preferences.
Okay, so a lot of financial data to consider, but also a very important leadership change was announced.
Right, Neville Noronha, after a couple of decades, is not seeking renewal of his term as MD and CEO next year. That's a significant announcement.
Yes, he's been a long-standing part of their story, right?
Absolutely. He's been with DMart since 2004 and has overseen their growth from just 5 stores to over 380. Truly remarkable. Think of him as the head gardener who grew the business from a small patch to a huge orchard.
Wow, that's quite the journey. And they've already announced his successor.
Yes, Anshul Asawa, who comes from Unilever, will be the new CEO designate starting March 15th, 2025. He's got a pretty impressive background in consumer markets.
So it's quite a big shift. And what does the outgoing CEO have to say about all this?
Neville is quite gracious, expressing his gratitude to his team and reiterating his belief that DMart's business model is built for long-term growth. It's like he's handing over the reins to the next gardener, confident in the strength of the roots he's helped grow.
He also emphasizes simplicity and efficiency as core values that have contributed to their success, right?
Correct. That's key to their continued relevance. He's highlighting that sticking to those principles will keep the business flourishing for many years. I mean, it's like a good recipe. You stick to it and you get great results every time.
Okay. And the new CEO designate, Anshul, he seems to have quite a diverse experience.
He does. He has experience in product categories, sales, marketing, and distribution across various markets in Asia and Europe. He's also been leading digital transformation and innovation efforts. So he brings a lot of experience to the table.
Right. And he will take over as MD and CEO on February 1st, 2026, after a transition period.
Correct. Neville will help with a smooth transition. So that's reassuring for the business and its stakeholders. Think of it as a well-planned succession in the garden to ensure the fruits keep growing smoothly.
So overall, a pretty big update from DMart, right? Some impressive growth numbers, some margin pressures, and a major leadership transition.
Exactly. It's a mix of good news, a few challenges, and a big change in leadership. It'll be interesting to see how the new CEO steers the ship moving forward. What are your thoughts on how the market will react to all this?